With me is John Ulrich, she's president and CEO, and also Whitney Solsher, she's the senior consultant and CIO. All right, markets, well, they are volatile. And first question is, what's causing all this?
Markets are pretty volatile right now, and there's several complicating factors that are going on, but the primary one, we believe, is what's going on in the war in Ukraine, which has really destabilized not only the energy markets, but most of the European economies due to the cutback of the energy supply there. And so you've got a number of different factors. Inflation is at the highest level it's been in 40 years, which is also being exacerbated by the war in Ukraine. And you're coming out of a very difficult time in terms of coming out of COVID, where the disruptions to the supply chains globally were already affected, causing additional volatility in terms of both the supply chains. And the final thing is, in order to try and control some of the inflation and bring it under control, we've got a very aggressive Fed increasing interest rates, about 4 times, a total of 325 basis points, 3.25%, which is the largest increase in this period of time we've ever seen. When you increase interest rates by that much, you really change the equation. So you've changed the equation in terms of the valuation metrics we use to value most assets.
How long can we expect this kind of uncertainty?
So I think that the length of time is really going to be data dependent. What the market wants is certainty, and so they need to see that in the numbers. They need to see inflation drop. They need to see unemployment start to rise. We are seeing some good data points, such as housing is starting to come down. Prices are starting to fall because demand is falling, and that's due to rising mortgage rates, which make it less attractive. The Fed's really playing a delicate balancing act between not too hot and not too cold. They don't want to cause a major recession. They really want to have a soft landing, and so they're trying to do that. But with inflation so high, they've really made it abundantly clear that that's what they're going to fight first, at the risk of causing a recession. This isn't just a domestic issue. It's not just domestic inflation, and so we really need a global response, and we are starting to see that from other central banks as they start to raise rates, which will again provide more certainty to the entire economy.
So let me ask you, Whitney. This is the big question. How can viewers hedge against inflation?
Well, it's a good point. In the past, typically things like hard assets, real estate, commodities, infrastructure, things in the ground have typically been good hedges against rising interest rates. In the short term, not a lot has worked, but over the long term, those things should do better. And I think it's important for viewers to understand that typically markets do recover prior to the recession being over, as the market is a forward-looking indicator. So there is brighter things ahead.
All right. How can they reach you?
You can reach us at our website, which is ulrichcg.com. And we look forward to any questions or thoughts from our viewers.